Welcome, YouTubenites. It's your boy, Austin, with the Finance Recap, bringing the top 5 stories in finance for the week, why you should care, and how it affects you. So without any further ado, let's get to it. The latest batch of U.S. economic figures are the final data points for the Federal Reserve's first meeting of the year from January 31st to February 1st, where they will announce their intent for interest rates. According to the latest data from the Commerce Department, the U.S. GDP grew at 2.9% in the fourth quarter of 2022, which is down from 3.2% in Q3, but higher than economists had expected, which is kind of like getting a B- on your report card. It's not great, you're still passing. Despite the growth, residential investment has declined by 26.7%, which lowered the GDP figure by 1.3%. Consumer spending also rose by 2.1% in December, which is 0.2% slower than the November increase, but still slowing a steady increase. So apparently Americans are still too busy returning Christmas presents to do any more spending. The Labor Department announced 186 new jobless claims last week, which is down from the prior week of 192,000 and the lowest since the spring. Additionally, December's seasonally adjusted unemployment rate was 3.5%, the lowest since February of 2020, which in itself was the lowest in 50 years. Utah had the lowest unemployment rate at 2.2%, while Nevada had the highest unemployment rate at 5.2%. Texas and Florida saw the greatest increases in employment, with payrolls increasing 5% and 4.8% respectively. All these factors, along with others we've covered previously, point to the Federal Reserve likely raising interest rates by only 25 basis points next week. Analysts believe that we are likely set up for an economic soft landing, avoiding a protracted recession. Stay tuned later this week for reaction and analysis of the Federal Reserve's decision and comments. The Justice Department has filed a lawsuit to break up Google's ad business on the grounds that they have engaged in anti-competitive practices in digital ad brokering. Google controls 28.8% of online advertising, according to market research firm Insider Intelligence, and advertising made up 80% of the company's $257.6 billion in revenue in 2021. This is not the first time Google's been in hot water over antitrust issues, and it's surely not to be the last. The company faced suit in 2020 and is set to go to trial in September over their monopoly in online search. In response to the latest lawsuit, a Google spokesperson stated that the DOJ is doubling down on a flawed argument that would slow innovation, raise advertising fees, and make it harder for thousands of small businesses and publishers to grow. Good thing we got a head start on the growth of our channel, or we may have to make a sacrifice to the algorithm gods and let someone's head roll down the pyramid. Yikes. Last year, Google attempted to avert lawsuits by splitting parts of its ad tech business into a new company under the umbrella of parent company Alphabet. Adding to the legal pressure, there is also the Competition and Transparency in Digital Advertising Act, a bipartisan legislation introduced by Utah Republican Senator Mike Lee. The act would prohibit companies with more than $20 billion in digital ad transactions annually from participating in more than one part of the digital advertising ecosystem. This would impact Google as they sell and purchase ads, as well as operate ad auction houses or exchanges. The lawsuit and the new legislation come at a difficult time for Google as they face a difficult regulatory environment and increasing competition from new players such as TikTok and artificial intelligence. The question now is, will Google go the way of Standard Oil, or will they Rockefeller on? So far, 29% of companies in the S&P 500 have reported earnings results, and the results are fairly mixed. 69% of the companies beat earnings per share expectations, which is below the 5-year average of 77% and the 10-year average of 73%. In aggregate, the companies are 1.5% above expectations, which are also below the 5-year average of 8.6% and the 10-year average of 6.4% above expectations. Additionally, 60% of companies beat revenue expectations, which is also below the 5 and 10-year averages. The price to earnings ratio, or total value of the company divided by annual earnings for the S&P, is currently at 17.8 as compared to the 5-year average of 18.5 and 10-year average of 17.2. One company that had a particularly strong quarter was Chevron. They reported a record profit of $35.5 billion in 2022, which is double the profit from 2021 and 30% higher than the next best year in 2011. They also announced a $75 billion share buyback program. Their stock was already up 53% in 2022 compared to the rest of the S&P, which is down 19%, so we'll have to see how this affects their share price. Tesla is another strong performer in Q4 with a record profit of $12.6 billion in 2022, up from $5.5 billion in 2021. They also announced price cuts up to 20% this month and expect to sell 1.8 million vehicles in 2023. On the other hand, Microsoft missed both earnings and revenue while having their slowest sales growth in 6 years as PC sales were down 28% and companies cut back on investments. Activist investor group Elliott Management Corp. has made a multi-billion-dollar investment in Salesforce. This is significant because Elliott is known for taking on tech companies and forcing changes that include sales and executive shakeups. Some of the company's previous targets have included PayPal, AT&T, Dell, and Twitter. In November, co-CEO of Salesforce, Brett Taylor, announced he would be leaving the company over tensions with founder and co-CEO Mark Benioff. Additionally, we reported earlier that Salesforce is laying off 10% of their workforce. This is after making several major acquisitions recently, including Slack for $27 billion in 2022 and Tableau for $15.7 billion in 2020. While revenues were up 14% in Q4, this is a slowdown from its peak during the pandemic of 27% revenue growth in Q4 2021. As businesses are currently being more cautious with investment, Salesforce had overhired during the pandemic, starting out with 49,000 employees in January 21 and ending up with 80,000 employees globally at the end of last year. Salesforce has appointed 3 new directors to their board of directors. Meanwhile, Elliott Management is preparing its own slate of nominations for the board of directors ahead of Salesforce's annual meeting in March. However, this appears to be a less hostile scenario than the proxy fight we already discussed between Nelson Peltz and Disney, as Jesse Cohn, managing partner at Elliott, has said he looks forward to working constructively with the company. We'll have to see how this goes. The Senate held hearings on Ticketmaster's business practices this week following the recent Taylor Swift ticket fiasco. The incident occurred when tickets for Swift's first tour in 5 years crashed Ticketmaster's website due to unusual bot activity that was 3 times higher than the company had ever seen. This resulted in the company being chastised in the hearings by Tennessee Senator Marsha Blackburn for not reporting more bot activity to the Federal Trade Commission. In her words, "I knew you were trouble when you walked in." The hearings also brought to light the 2010 merger of Ticketmaster and Live Nation, which was allowed under a consent decree stipulating that the companies could not threaten or retaliate against venue owners for using other ticketing agencies or concert promoters. However, the merger has led to a 50% increase in ticket prices for the top 100 tours since the merger. Ticketmaster and Live Nation currently hold 80% of the market share across NBA, NHL, and NFL teams as well as their venues, and have a growing presence in smaller venues. Many venues and entertainers as well feel there is no choice but to use Live Nation Ticketmaster. The result of the hearings is that Ticketmaster has successfully accomplished something we've not seen in years. Republicans and Democrats united in a cause, and in this instance, it's addressing the situation via the Justice Department or legislation if needed, said Minnesota Senator Amy Klobuchar. So tell me in the comments below, do you like the convenience of Ticketmaster, or are you ready for new eras of ticketing? Hey YouTubeites, thanks for watching. Make sure to like, share, and subscribe, as well as commenting below on any topics you think that we should cover in the future. That's how we keep this show interesting for you.